mark my words, at the end of this next year, what's going to happen is we're going to have some serious affordability issues, and we're going to have more and more governments are going to step in for rent control.
So you probably know and love Ken McElroy. He's an amazing, inspirational guy. Talks a lot about inflation, multifamily investing, different things that are happening in the world. He partnered and has partnered with Robert Kiyosaki as his rich dad real estate advisor. Ken has over $1 billion in real estate investments. And again, he has a lot of insight to share. So I was able to interview him recently. I'm going to break this interview down for you, but he talks about 2022, what's going to happen, particularly with rent control, with the Fed, increasing rates. Like, what is that going to look like? And he gives some advice at the very end. So if you stick around, he gives some advice at the very end on what you should do, or at least what you should consider looking forward to 2022. So I'm going to break this down for you. My name is Bronson Hill. I'm a multifamily operator. We have about 150 million in real estate assets. I'm going to try to make it real simple. And go ahead and smash that like button, and we're going to jump into it.
Well, the biggest one are the policies that we're starting to see, at the city, county, state levels. I think those are making a lot of difference. I was meeting with the head of capital markets from Berkadia 2 weeks ago. He came out for Christmas, and he said that capital is really taking a hard look at where it wants to go based on policies. And he specifically cited St. Paul, Minnesota as one of the markets because they put rent caps in place. He specifically cited Oregon, and he specifically cited Seattle and San Francisco as areas that they're concerned about because of the policies that are happening there. So I think when a lot of times when you're looking at real estate, you oftentimes don't think about whether or not how capital is looking at real estate. So what I'm starting to see right now is that they're really starting to take a hard look at where do they want to be and where are they going to put their money and who are they going to back behind? Because obviously the team, like the guys on this webinar here, are obviously all very qualified, but they're making kind of the same decisions. So I think you're going to see a lot more of that start to pop up, and I think they're very, very, very concerned about what's happening from a vacancy standpoint. Now, this is really generalizing, but he said, I asked him, I said, so when you guys are underwriting, how are you underwriting? He said, well, everything on the coast, and he specifically said West Coast, is basically about 15%. And then everything on the inside is maybe 5 to 6. And then in the Northeast is very high again. And then the Carolinas and Florida are in pretty good shape. So now that's very broad. It's not state or city, obviously in submarket driven, but we were having a very broad conversation. And so the conversations at the private equity, institutional equity level are at the same kinds that we're going to have today here with this group.
Okay, so in this clip, Ken was talking about what to expect in 2022. Now, he talks about Berkadia as a large lender, commercial lender, and saying that capital is really taking a look at where they want to put their resources. So again, if you are going to buy an apartment building, you need to have a lender that's going to lend you the money. So they're saying, we're not sure if we really want to be in areas where there are rent caps or there's some sort of rent controls in place, because it really limits what you're able to do with your property. He also mentioned on the West Coast, which is where I live in Los Angeles. Of course, we don't invest in Los Angeles; we invest all in the Southeast. But he said because of these population migration, the vacancies are very high, and he's going to get into population migration in a little bit. But in this next segment, you're going to notice he talks about the rising interest rates. That interest rates are going to rise. What does it look like with inflation? And what should you expect as far as asset valuation in 2022?
Same with Rod. I know he did a video at the same time, but you got to kind of draw the line in the sand based on the information you have at the time, and that's changed, and it continues to change. And all we can do is try to make educated guesses on whatever the next move might be. Everybody, if you look at, I think that Powell's still hanging on the word transitory, as inflation. You guys know a third of the CPI index is made up of housing, and there's a lag. So all the inflation numbers that we've seen, the 4, 5, 6, 6.8, I think November, that if you really look, it hasn't really been calculated in yet. So, there's PPI, which is producer price index, and there's CPI, which is consumer price index, and they mean what they mean. Producer cost, raw goods and materials, that's one thing. That's higher than CPI. So I think, to your point, Rod, we're going to start to see some serious inflation. It's going to get worse. And if the Fed, they went from, we're going to increase rates to now we're going to do it 3 times. I think they came out and said last 2 weeks. That's just going to slow things down. It's just going to make it worse. With regard to inflation, demand of anything is the key driver of inflation. So demand of money, demand of rentals, demand of, gold, demand of, whatever it is, so that's always at the moment, especially with these supply chain issues, kind of the key driver. So to answer your question, I think that whenever interest rates go up, then less TVs, less cars, less apartments will be built, all that stuff happens. So, the price of money goes up. So that means your mortgage payment goes up, and that means that things slow down typically. Now, on the other side of that, there's a lot of people chasing yield and trying to get out of cash, and multifamily is something that everybody wants right now. So it's never been this competitive that I've seen. We like you guys, we underwrote hundreds and hundreds of properties last year. We made offers on 87 deals.
Wow.
And we got 3.
All right, so in this segment, Ken talks about inflation, right? He says that housing is actually 1/3 of the inflation number, but there's a lag. So it doesn't happen right away. You don't see immediately inflation rising, right? So inflation's rising, but he said it's going to get worse. Again, we've seen this, that basically we're producing less goods and services, but they've printed all this money. So again, there's a limited supply of goods and services, actually less goods and services than there were before. And so it's going to lead to perpetual inflation. We've talked about this in some of our inflation events that we do. We actually do events on inflation and on multifamily. We had Ken at this event recently talking about this. But he said basically when interest rates go up, typically demand for things like cars or TVs or apartments go down. Now later he talks about the apartment supply issues where there's just a huge shortage of supply in apartments. We'll get into that in a little bit. But he said they made 87 offers in 2021 and only got 3 properties. So again, it's very, very competitive. A lot of other groups, there's a lot of money sloshing around. So it is competitive to find multifamily apartments. But if you can get a hold of them, it's obviously getting out of cash is really, really important. So in this next clip, Ken talks about population migration trends.
I look at all that stuff. We look at all that stuff. Our acquisitions and analysts and everyone in our company looks at all that stuff. And we're trying to pick the right market generally. And like everyone, is we want to be, we don't want to be a pioneer, but we also want to be there when the market, kind of gravitates with us. We don't want to be a market maker. Well, I'll tell you where we are. I live in Scottsdale. I've been here forever. Arizona is certainly one of the markets that's growing. It grew by 98,000 people last year. Texas grew by over 300,000. Florida grew by over 200,000. The North Carolinas grew over by 93,000. So just those 4 markets are markets that you want to look at. I think you always got to remember that real estate, don't forget, exists for people.
Yeah.
Period. So, sometimes people forget about that. So if there's no people, like going to a mall, and the mall retailers don't make money, then they can't pay rent to the mall owner, et cetera. So all of that stuff happens organically based on people. So if you pay attention to where people are going, then and you can try to be in front of that. So we like Houston, we like Dallas, we like Austin, we like and a lot of this is red state related. People are moving there, I think, because of safety and weather and property tax issues and low crime. They're not defunding police and stuff like that. Now, not to be political, but those are real issues. People are making decisions based on with their wallets. And those are facts. And all you got to do is look at the way moving trucks. You can track your moving trucks with North American Van Lines, U-Haul, Ryder. They all track one ways. You look at the out-of-state driver's license that are being turned into these places. Those are all real facts. Those are people moving, either renting or buying, and then they're creating commerce in those areas, and that's putting positive everything, the sports arenas, the concerts, the restaurants, in Scottsdale, just here, even I've never had to put a reservation in before. Now I have to book stuff a week out. And that's because people are moving here, and so we're constricted. And so that's why we're having the rent growth. We don't have the supply with housing, multifamily, industrial, commercial, office, retail, all that stuff is on fire here because of all the people.
So Ken says here it's really important to stay ahead of population migration. So obviously he's been buying in Phoenix. I mentioned Florida, Texas, some of those southern states. For example, we only buy, areas like Jacksonville, Florida, Atlanta, Georgia, things like this where we see population growing. I mean, the Atlanta area is expected to grow around 30 to 35% by 2030, which is just phenomenal growth. So if you buy in the right area, the rising tide will raise all ships. Right? So it's really important. Now, Ken, in this next section, he gives his outlook for 2022. He comes across extremely bullish on buying apartment buildings, getting out of cash, using other people's money to hedge against inflation. So enjoy this part.
But for us, the way I look at this is we're if we can borrow at 2 3/4, let's say, which is what we're at right now. Less than 3, and interest rates are, let's say, north of 6. I look at that as free money. Yeah. So I look at that as a way to borrow other people's money, put it in, and get 70% of that from somebody else, and I'm hedging inflation using other people's money. So that's how I see it, and so. But even with that, so does everybody else, I think, because it's interesting times. It's tough, and but I agree with Michael and Rod. I think next year is going to be a banner year, and I mark my words. At the end of this next year, what's going to happen is we're going to have some serious affordability issues, and we're going to have more and more governments are going to step in for rent control.
So again, using other people's money to hedge against inflation. When you can borrow at 3% and inflation is 7 to 15%, we don't know exactly what it is, but it's probably higher than what they're stating, you're actually able to hedge against inflation using other people's money by investing in multifamily. You take out this big loan, you get debt on it, and inflation's higher. It's really a great long-term way to grow your wealth. So that's something that I've been able to do over the years in multifamily investing. And then now Ken gets into kind of his recommendations and his advice for you in 2022. Now, again, this isn't personal advice for you, but just saying things to consider as you look at 2022.
They need us. Rod said it perfectly. There's 6.8 million. We're 6.8 million housing units behind right now, period. That's facts. That's math. So, the more stuff that they do, it's just going to slow it down. And what they really need is to figure out a way to speed it up through tax credits or Section 8 or giving us more money or relaxing zoning or something, because what they need is supply. I've gotten the hell beat out of me over a long period of time, but I think that the wisdom that I have is that I think a lot of times people go out and they think real estate is like a transaction, like a stock. Don't be duped into that. There's a whole team and education around the finding of the deal and the managing of the deal and the reporting the investor, and all that stuff is really, 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 really important.
All right, so Ken says 6.8 million more apartment units are going to be needed or needed currently right now. So if you can tell, read between the lines, he's investing. He says, you should consider getting involved with this, and also doing educational things like watching this video, going to events, going to conferences, going to meetups. These are all things that you can really help yourself in a powerful way. But I wanted to see in the comments below, what did you get out of this video? What did you hear Ken say that maybe I didn't talk about, or some things that you're doing in 2021? So stick that in the comments. Consider subscribing to this video if you made it this far. We talk about all things inflation, investing, real estate. We also are doing deals. So if you want to join our investment club, it's at bronsonequity.com, or you can check check it out down below. We're doing multifamily deals. But look forward to seeing you on the next video.